A brand built on the third place, that cozy spot between home and work, now wrestling with shrinking traffic, margin compression, and boycotts that wiped out billions in market value. Stores are being closed, menus simplified, and a billion-dollar turnaround is underway. Starbucks, the brand that defined premium coffee culture and transformed the simple act of buying coffee into an experience, is facing its biggest crisis in decades. The new CEO, Brian Niccol, is betting that a hard reset on operations, service, and store design can restore the experience and the economics that made Starbucks iconic. What the hell happened? How did the king of coffee lose its crown? And can the new CEO pull off one of the most ambitious turnarounds in retail history? Welcome back to the Capital Navigator, the channel where we explore the history, strategies, and business models of the world's most influential companies. Today, we're diving deep into Starbucks Corporation. For decades, they weren't just selling coffee, they were selling a lifestyle. Premium prices, premium brand, premium experience. We'll break down the history, the business model, the financial deterioration, the strategic pivots, and most importantly, what this means for investors and the future of this iconic brand. Let's dive in. The origins. Building the coffee empire. Let's rewind to where it all began. Starbucks Corporation was officially formed in 1985, though its roots trace back to 1971 in Seattle, Washington. Initially, it was just a small operation focused on selling high-quality coffee beans. Nothing fancy, no espresso bars, just beans. The real transformation came with Howard Schultz in 1982. After a trip to Italy in 1983, Schultz was mesmerized by the espresso bar culture there, the social atmosphere, the craftsmanship, the ritual of coffee. He had a vision. What if we could bring that experience to America? In 1987, Schultz's company, Il Giornale, acquired Starbucks' assets and rebranded everything under the Starbucks name. This is when the magic really started. Schultz introduced the revolutionary concept of the third place, a destination between home and work where people could relax, connect, and enjoy premium coffee. It worked, massively. After going public in 1992, Starbucks exploded. International expansion kicked off in 1996 with the first store outside North America opening in Japan. The company became a global phenomenon, consistently innovating with products and technology. In 2001, they introduced the Starbucks card, a game changer that would later evolve into the Starbucks Rewards loyalty program. Then in 2015, they launched Mobile Order and Pay, allowing customers to order ahead through the app. This digital ecosystem became a massive competitive advantage, until it didn't. We'll get to that. In 2018, Starbucks struck a global coffee alliance with Nestlé, giving Nestlé rights to sell and distribute Starbucks packaged consumer products worldwide. Smart move to leverage Nestlé's distribution network while focusing on what they do best, running cafes. Fast forward to September 2024, and the company was in crisis mode. CEO Laxman Narasimhan was out, and Brian Niccol, former CEO of Chipotle and the guy who turned that company around, was brought in as chairman and CEO. Niccol immediately launched the Back to Starbucks strategy, a $1 billion restructuring plan to simplify the menu, invest in employees, called partners at Starbucks, and close underperforming stores, roughly 1% of North American locations. So how did we get from global domination to emergency mode? Let's break down the business model first. The business model, a premium ecosystem. Starbucks' business model is built on a strategy of premium differentiation and global scale. They're not competing on price, they're competing on experience, quality, and brand. The core value proposition? That third place concept, a welcoming, community-oriented space where you can work, meet friends, or just escape for a while. There you can find premium quality, specialty coffee and customizable artisanal beverages. Digital convenience. The Starbucks Rewards program and mobile app create a seamless ordering, payment, and rewards ecosystem. Brand prestige. Starbucks isn't just coffee, it's a lifestyle brand. Starbucks is the world's leading roaster and retailer of specialty coffee, monetizing a retail engine that runs on three pillars: company-operated stores, licensed stores, and a consumer packaged goods business that rides Nestlé's distribution. The network has 40,000 plus stores worldwide. That's a massive scale. Roughly 52% are company-operated and the rest licensed, allowing local expertise and access to prime real estate like airports and supermarkets without Starbucks putting up all the capital. Now, what are the competitive advantages? Brand power. The Starbucks brand is their most valuable intangible asset, associated with premium quality and aspirational status. People aren't just buying coffee, they're buying into the brand. Digital network effect. The mobile app and mobile order and pay are incredibly valuable for driving loyalty and recurring transactions. They have 75 million active members globally, with 33.8 million in the US alone. The Starbucks card is a convenient payment method, and the ecosystem allows them to collect data to personalize offers and optimize operations. Economies of scale. As one of the world's largest buyers of Arabica coffee beans, Starbucks has significant negotiating power with suppliers. Their global roasting and logistics infrastructure ensures product consistency. But these strengths only work if the in-store experience, the human service that differentiates a latte from a commodity, feels worth the price. So on paper, this looks like a fortress. Global brand, digital dominance, massive scale, loyal customers. What could possibly go wrong? Clouds on the horizon, the problems piling up. Despite the brand power and global recognition, several storms converged. Starbucks has faced a series of critical problems and challenges in recent years, culminating in that costly $1 billion restructuring and store closures across North America. Reputational risk and boycotts. In recent years, Starbucks has faced consumer boycotts based on perceptions of their social or political actions. Boycotts linked to geopolitical conflicts have caused significant market value losses. The boycotts tied to perceptions of their stance on the Israel-Palestine conflict resulted in market cap losses. The impact was especially severe internationally. For example, their franchisee in the Middle East and North Africa region had to lay off 2,000 employees due to plummeting sales. When your brand becomes politicized, you risk alienating massive customer segments. And that's exactly what happened. Intensifying competition. Competition is substantial and intense across all channels and markets. In China, Starbucks' second largest market, local competitors like Luckin Coffee have surpassed Starbucks in store count and are competing with a low-cost, digital-first efficiency model that challenges Starbucks' premium positioning. Starbucks' market share in China has noticeably declined. In the US, rivals like Dutch Bros and 7 Brew are attacking the drive-thru and convenience segment with speed, efficiency, and sweet beverages. Meanwhile, chains like McDonald's, McCafe, and Dunkin' compete in the value and convenience market with lower prices, attracting price-sensitive customers. And here's the kicker. Starbucks has experienced declines in comparable global sales and transactions, indicating that the customer experience has deteriorated due to operational bottlenecks and price sensitivity. Brand and consumer challenges. Price sensitivity is real. Persistent inflation has reduced discretionary consumer spending, leading customers to opt for cheaper alternatives. Global comparable sales fell 2% in Q3 2025, driven by a decline in transactions. But it's not just about price. The in-store experience has suffered. The massive success of digitalization, particularly mobile order and pay, created operational bottlenecks and overwhelmed store capacity. This deteriorated the experience for both customers and partner. CEO Brian Niccol pointed out that the company had drifted from its core. The previous management strategy of removing staff with the hope that technology would compensate was not an accurate assumption. The company now needs to achieve a service time of 4 minutes or less in cafes and drive-thrus, which requires menu simplification and better technology implementation. Employee unionization. Investment in employee wages and benefits is an ongoing pressure on operating costs. Unionization activity, led by Workers United in the US, is a continuous risk that threatens to increase labor costs and reduce operational flexibility. The financial deterioration. Numbers don't lie. The slowdown is visible on the scorecard. Total sales climbed from $32.2 billion in 2022 to $36.1 billion in 2024, but growth nearly stalled, up just 0.6% year over year. Starbucks has faced significant and growing margin pressure in 2024, and especially in the first quarters of fiscal year 2025, due to strategic investments and restructuring costs. Despite revenue growth, the operating margins went from 14.3% in 2022 to 16.3% in 2023, then dropped to 15% in 2024, a contraction of 130 basis points. This was primarily due to investments in employee wages and benefits, deleveraging, and increased promotional activity, despite the offsetting effects of pricing and operational efficiencies. Earnings per share also declined. $2.83 in 2022, $3.58 in 2023, then down to $3.31 in 2024. But things are not improving in 2025. In fact, they're getting worse, primarily in operating margins. The first quarters of 2025 reflect the impact of costs associated with the Back to Starbucks restructuring and the continued weakness in comparable transactions in North America. The most notable aspect of 2025 results has been the operating margin contraction due to restructuring expenses and labor investments. In Q1 2025, the operating margin fell to 11.9%, versus 15% in Q1 2024. Then it collapsed in Q2 to just 6.9%. The consolidated operating margin for the first 3 quarters of 2025 was 9.6%, a contraction of 550 basis points compared to 15.1% in the same period of 2024. This has been reflected in the stock price, which has experienced drops this year, down 30% from its peak in March 2025. The market is pricing in the cost of the $1 billion back to Starbucks restructuring, which has contributed to operating margin contraction. This transformation is costly, and there's uncertainty about whether it will generate returns that exceed the investment costs. Analysts are concerned about the persistent decline in comparable global transactions, 6 consecutive quarters of decline. This indicates that consumers are price-sensitive to Starbucks and are seeking cheaper alternatives in an inflationary environment. So the question becomes, can they turn this around? The strategic plan. Back to Starbucks. Given all the recent problems, Starbucks is undertaking a profound strategic reorientation under CEO Brian Niccol's Back to Starbucks plan. The expected new investments focus less on rapid store footprint growth and more on intensive investment in operations, technology, and human capital to correct bottlenecks and restore operating margin and premium experience. Core pillars: simplify the menu, raise staffing in the right moments, and purge poor locations so the base is healthier and the experience sticks. Closing unprofitable stores. We'll dive deeper into this shortly, but roughly 1% of North American locations are being shut down. Investment in human capital. They expect to invest over $500 million in additional labor hours in company-operated U.S. stores during fiscal year 2026. This investment supports the new service model and aims to improve partner retention and productivity. Service model reboot. The Green Apron service is described as the company's largest investment in operating standards and customer service. Rolling across U.S. company-operated cafes by mid-August, it centers on 5 key moments of craft and connection. Greet at the door, greet at handoff, deliver a perfect cup, and make a human connection. This is Starbucks trying to hard-code soul back into speed. Smart Queue technology. They're implementing Smart Queue, an advanced order sequencing algorithm designed to ensure consistent and timely service across all store access points. It uses algorithms to enhance staffing and scheduling, helping baristas deliver more consistent and higher quality service. Digital refresh. A summer 2025 app update lets customers schedule pickup for mobile orders and adds clearer price transparency. While the company halted new store construction and major renovations in fiscal year 2025 to redesign its approach, capital will be directed toward renovating and optimizing the existing portfolio. Accelerated uplift and remodels. They plan an uplift renovation program with a targeted investment of approximately $150,000 per store. These renovations are expected to provide a more premium and welcoming experience, with excellent seating for different occasions, reinforcing the third place concept. Portfolio surgery. The massive store closures in 2025. The store closures in 2025, approximately 1% of North American locations, are a strategic and costly measure that's part of the $1 billion Back to Starbucks restructuring plan announced by CEO Brian Niccol. The reasons for these closures are multifaceted, centered on optimizing the asset portfolio. Locations that are financially suboptimal or cannot achieve expected profitability are being closed. Also, locations that don't align with new efficiency standards and are unable to provide the in-store experience that customers and partners expect will be closed. CEO Niccol noted that the company is actively eliminating stores that don't meet cafe environment criteria or the brand promise. The company is returning to its coffeehouse identity roots. For example, they're closing fewer than 100 locations operating under mobile order and pickup-only concepts, especially those in office buildings with little or no seating, because these formats are likely lower margin and don't reflect the coffeehouse vision. The goal is to move away from a purely transactional environment and adopt the cafe atmosphere. The coffee itself has competitors everywhere. Experience is the differentiator. A friendly greeting, a predictable handoff, a clean seat to answer emails or catch a breath. Starbucks' strategy recognizes that an app can bring you to the door, but humans, and the room they create, make you return. That's why the turnaround is so focused on service rituals, staffing, and space. It's not nostalgia, it's the business model. Closures are concentrated in urban stores that have seen a permanent reduction in foot traffic. This is related to consumers migrating to suburbs and decreased demand in office locations due to remote work. The primary objective behind Starbucks' 2025 store closures is to clean up the asset portfolio and restore the brand's identity as a welcoming destination and a premium service place, the third place. The overarching goal is to eliminate locations that deteriorate the customer and employee experience. Store closures, while costly in the short term, including approximately $450 million in lease termination charges, are a strategic acceptance of short-term revenue contraction to lay the foundation for a more efficient and profitable store base in the long term. In summary, Starbucks is navigating its most challenging period in recent history. The perfect storm of geopolitical boycotts, fierce competition from rivals, and self-inflicted operational failures has led to shrinking margins and plummeting stock. The strategy is clear. Close unprofitable stores, simplify the menu, invest in employees, upgrade technology, and return to the third-place coffeehouse roots that made Starbucks special in the first place. Will it work? That's the billion-dollar question, literally. But if Nickel can execute, if he can restore the brand identity, improve the customer experience, and return to sustainable profitability, this could be one of the greatest corporate comebacks in retail history. So what do you think? Is Starbucks' Back to Starbucks plan going to work? Or is this the beginning of a slow decline for the coffee giant? Drop your thoughts in the comments below. I'd love to hear your take. And if you found this deep dive valuable, do me a favor. Hit that like button and subscribe to the Capital Navigator. We break down companies like this every week, giving you the strategic insights and financial analysis you need to understand the businesses shaping our world. I'll see you in the next one.